Hello and welcome to FT Markets here in New York. Central banks normally discuss the outlook for the economy, inflation and interest rate policy. Last week, however, the US Federal Reserve created a bit of a stir in the equity market when it identified stretched valuations in certain areas of the equity market. Joining me now to discuss the outlook for equities in light of what the Federal Reserve said last week is Nicole Bullock, who is our US equity correspondent. Nicole, thanks for joining us.
Thank you.
So the Fed has kind of stirred the waters here with its talk about stretch valuations. What does this mean for investors who currently own small caps, and particularly the biotech and social media names, do you think?
Well, anytime you have a central bank sort of calling out a specific sector of the market, certainly people will take notice of that. And we did see last week that, for example, biotech shares really had a bit of a sell-off midweek and then came back a bit, but not totally. And obviously the most famous example of this is the irrational exuberance, back in the 90s.
Yes.
So, I mean, it really depends on, I think, what an investor's philosophy is in buying these. And there's one camp that says that higher valuations for these higher octane stocks, like these smaller cap biotechs, really just reflect the growth expectations. And if those pan out, then you have your lottery ticket. You've bought the right one.
If a company gets its drug deal or drug development right, calls that right, as we've seen earlier this year, some small caps have gone up 500%.
That's exactly
in the
right.
biotech sector.
And if for some reason the research doesn't pan out, or it just doesn't work out for this company, then obviously the valuation is inappropriate.
Yeah.
So it really just depends on how you look at it. So analysts that play the sector that way or look at the sector that way, have that kind of thinking about higher valuations. Now, of course, this is all coming at a time when the Fed has been pumping a lot of money into the system. The general indexes are at all-time highs. The valuations are not at all-time highs, but they're certainly not flashing bargains. I think they're probably slightly above the average long-term averages. So against that kind of backdrop, it gives people a lot of pause about where we are in the market right now and where certain valuations are. So I think, the Fed, it really what the Fed said has just really resonated with some people along those lines.
But I think we also have a chart which shows that over longer term, biotech valuations aren't, they're nowhere near some of the extremes we've seen in the past. So
some analysts pointed to the Fed's comments regarding biotech as not being specific to small caps. So if you look at, say, the Russell 1000, which is, I believe, the chart that we have, shows that we're not anywhere near what we saw, back in 2000.
Like, I suppose back in February we saw a big shakeout in sort of valuation or highly valued stocks, also known as momentum stocks. That's sort of come back, and the Fed seemed to also address the fact that we've seen a big comeback here in a lot of these stocks, and how volatility has also dropped. And they were sort of raising red flags. I suppose the big difference between now and February is that back early this year, people were expecting interest rates to rise. So there was this theory that, as rates rise, you're having to discount the future cash flows of these pie-in-the-sky companies at a higher rate. And that was seen as one of the reasons why momentum plays sort of backfired. Now, of course, we've actually got long-term yields falling. So I suppose the general interest rate environment remains quite supportive for people betting on high-growth stocks.
Yes, that's right. And it also comes down to the economy as well, and how that feeds into the psychology of investors. So at a time when the economy is not really growing gangbusters,
yes.
going gangbusters, there's one school of thought that says you pay up for high-octane stocks because that's the only place where the growth is. However, if you do believe that the economy is picking up speed, and in the second half of this year and into next year we're going to see much stronger growth, then a rising tide lifts all boats, and you don't really need to pay up for that kind of growth. You can maybe go with a larger cap, safer alternative that will just see its volumes rise along with the general economy.
And I suppose the other important point to make is that while the biotech index remains up about 10% so far this year, the much broader measure of small caps in general, the Russell 2000, has actually now turned negative again for the year since the Fed made its remarks. Do you think there's a rotation coming for small caps, or that they remain just too risky for many investors?
Well, I think there's still a lot of skepticism in the market about the levels of small caps, and that's why you're not seeing things come back to where they were. And again, it goes back to the economy and how you feel about where you need to be in order to pick up that growth. And if you feel you need to reach into riskier sectors to pick up that growth, then small caps should be leading. And if you don't, then you don't really need to do that. And that's really what we saw play out in that cycle this spring, where you had some shakeout out of small caps. And I believe there the valuations still, we're still not down to, we still haven't seen them become value plays or anything like that. So there has been a downdraft, but it's a downdraft from quite a high level.
Great, Nicole. Well, I suppose investors are going to continue to debate valuations for small companies now that the Fed has sort of put some petrol on the fire, so to speak. That's all from the FT here in New York for now. Thanks.